Hey, hey, hey. Hey, how are you doing today? Welcome back to another week of the KBCR TV Show with Michelle Green. We are going to discuss credit and financial tips here. And today we are going to be talking about mortgage secrets. That's right. So come on in the room. Make sure that you click that subscribe button at Kingdom Builders Credit Repair, and that you go ahead and share this with a friend and get ready to ask your questions down below in the comment section. That's right. We want to make sure that we answer any questions that you may have. So let's get into today's message because we got a lot to talk about. Okay? All right. Listen, we are powered by the CTR Media Network. I never want to leave that out because this gives us the ability to be able to be seen and heard throughout billions of nations. We're talking 140 countries that the CTR Media Network allows us to be seen by billions of people all across the world. So thank you as a shout out to CTR Media Network that powers Kingdom Builders Credit Repair's TV show. All right, now that we got all of our kudos out of the way, let's go ahead and jump into our lesson for today. Y'all like how I rhymed that, right? I know you liked it. I know you did. But anywho, so first off, we always want to talk about how credit works. So what is credit? We have to understand that credit is the ability for us to be able to make a purchase for something that we don't have the money for right now. So as we start out as individuals, no matter what age we start working in the workforce, right? We begin to make an income, and that income turns into things that we don't actually have enough money to pay for: a house, a car, or a place to live, or food, or clothes, or shoes to go on our feet. Whatever the item is that we want to pay for, sometimes we just don't have enough money because maybe we weren't fortunate enough to start having the savings account when we were little, like most people. So what are we doing? We are allowing the opportunity for us to go to a bank or a credit union and be able to purchase whatever it is that we need with the ability to finance it. So once we have an item that is financed, it hits our credit, and there begins the whole process of why we are here today to talk about how to manage your credit and your finances to the best of your ability with Kingdom Builders Credit Repair. So now that we know what credit is and how to manage our credit a little bit, we know that we got to pay the loan back, we got to pay the credit card back or pay it down, and we have to keep that going for basically our entirety of our life. So we don't want to be confused around, if it's something that we just do for one time or we do it all the time, the entirety of our life. Yes, credit is up there with oxygen. So it is very necessary that we have credit our entire lives. All right. Yes, yes, yes. So we got that out the way. So now let's jump into the topic of buying a house. So not just buying a house, but also for the ones that are in a house already, have made your home purchase, because we have hundreds of thousands of clients that have already made their home purchase, that send over their pictures of their homes. And we have shared some of their success stories on being able to purchase the house of their dreams. Some of them 2 or 3 houses of their dreams. So what we want to focus on today is the mortgage secrets, the secrets around mortgages. This actually happened this week with one of my clients, and they know who they are. But we had a conversation around the mortgage that they had already purchased. So I want to talk about today the different kinds of mortgages that you can obtain, but the things that you need to be aware of. So the first thing that I want us to understand, that no matter what you purchase, no matter if it's a house, a car, or whatever it is, but specifically and especially a house, is when you make the purchase of a home, you want to understand that even though you have terms and conditions of how long you are being financed for, you don't actually have to pay the mortgage over that term. So what does that mean? That means that literally you could pay off the mortgage in less time than what you are financed for. All you have to do is calculate what is the total payoff. A lot of times we don't begin to realize that we have paid hundreds of thousands of dollars until we get older. I would say our 60s or 70s of our life, and we look back and we see, like, my goodness, I have paid like almost $1 million of debt and paid it off or have it currently now. So we got to understand that we have the ability to be able to pay off these mortgages. We have the ability to be able to, even though we're financed through the bank or credit union, we still have the ability to be able to pay off the debt sooner than we are financed for. So I want us to get in our minds that we don't have to wait 30 years to pay off our mortgage. We don't have to wait 25 or 60 years, because sometimes when we do refinance, we end up paying a longer term of the loan. So let's talk about the different kinds of loans that are available. So first, I want to talk about the fixed rate mortgage. And what is the secret around the fixed rate mortgage? Well, the fixed rate mortgage, it means literally that if you purchase a house, let's say for $250,000, then that is going to be a set amount of interest as well as a set amount of monthly payments that you pay over a period of 30 years if it is a 30-year mortgage. Now, if it's a 20-year mortgage or a 15-year mortgage, most of us don't even know that the fixed rate mortgages have the option of being able to pay it in 15 or 20 years. You just need to ask the people that finance your home, what are the other options when you make the purchase? So when you make the purchase of the home, you don't want to go into the equation just assuming that the only option is for you to pay that mortgage off in 30 years, because that is not all of your options, okay? So the thing that we also need to understand is what is interest and how it really impacts our mortgages, okay? So when we look at interest, if I were to borrow, let's say, the $250,000 from a mortgage lender, which we do have homes that have been financed and currently have a home that is financed. Okay, so we're borrowing $250,000. That is the principal amount of the mortgage. But what we fail to understand really about mortgages is the interest, how it really impacts us. So interest is separate. Even though the mortgage lender or the bank or credit union financed us for $250,000, we got to understand that the interest is going to accrue over time. And a majority of the money that we pay up front is the money that we are paying to the bank or the credit union, to that mortgage lender, for being able to finance the $250,000 principal balance. So what does that mean? That means that the interest that I will be paying through my monthly payment every month is actually going to accumulate almost the same amount of money that I have purchased the house for. So yes, I am saying that technically, if you wait the 30 years to pay off your mortgage, or if you refinance and then you have another 30 years after you have paid into the mortgage for 10 or 15 years already, you start the process over for the interest rate to be accrued all over again from the beginning. So that means you'll be paying $500,000 for the same $250,000 mortgage that you originally financed. So we got to understand how the interest, how important it is for the interest for to be accrued over time, for us to try to figure out how we can pay these mortgages off before the freaking time period that they have limited us to. So we want to make sure that we are putting together a plan to pay off $250,000 or $300,000 or $500,000 or whatever your mortgage amount is. You got to think about how can you pay off that mortgage sooner. Well, one of the things that we already talked about in how you can do that is making sure that you are not just making a monthly payment. You have to make multiple payments in 30 days in order for you to affect your principal. But you cannot pay the monthly payment. If you're splitting it in half, you cannot pay it too early. You have to split it in half and pay half of it 2 weeks before the due date and the other half of the week of the due date. But you want to add a little bit more than what you are basically due for. So if my monthly payment is $1,500 a month, I want to take more than $750. I want to bump that $750, which will be half of the $1,500, add it to the additional payment that I'm making, which would be my 2 times a month. I'm going to bump that up to $800 every 2 weeks instead of $750. And if you can do more, definitely do more. If you can bump that up to $1,000 every 2 weeks, then make it $1,000, because the key is that you will no longer be paying as much interest on the multiple payments that you're making in the 30 days of the payment. So we want to make sure that you are making more than just the minimum monthly payment, but to understand that if you're just selling for the 30 days of the mortgage at a fixed rate, then you are going to probably pay double what the mortgage balance was in the first place. That's right. So we got to understand that we are not to just get caught up into the fact that we got a fixed mortgage, because even the fixed mortgages still accrue lots of interest at the beginning of the loan. That's right. So we're talking about, if you are looking at least a 30-year mortgage, about 15 years is going to accrue most of your monthly payment. So that means that you haven't even touched the balance of that $250,000 balance. So we want to make sure that you get it, that you understand that this is not just a game, for you to understand from the perspective of being able to purchase homes, but to also be able to understand how you can pay off your home and own your home outright, so that you can actually leave a legacy for your family. Now, one of the things that we incurred over this week with one of our clients is the fact that the bank or the credit union really does want you to refinance the home. But when you refinance that home and you're starting all the way over from the beginning, what is happening is you are not thinking about, okay, I know I can pay off my debt if I get this refinance, because it's going to put some money in your pocket. And sometimes the banks will even offer to pay off your credit cards on your credit report, and offer to pay off any open loans on your credit report, in addition to refinancing the house. So sometimes we can look at pulling the equity out and getting a second mortgage or a home equity line of credit. If we are doing a second mortgage, that means that we have two mortgages, and that means that you'll have to continue to pay your first mortgage, but you're also being financed so that you will have a second mortgage to pay for. And then when you're doing the home equity line of credit, it's literally just like a credit card, where they allow you a certain amount of money to pull out of the equity of your home. Now, if you don't know what equity is, let me explain. Equity is simply the fact that you bought the home for $250,000, but if you look at homes, they are an asset, which means that they will increase in value. So as they increase in value, what is happening is that same $250,000 home is now worth, let's say, $350,000. So your equity is the difference between what you bought the house for versus what the house is worth now. So if you're pulling out $100,000 in a home equity line of credit, that means, number one, that your credit has to be up to par. You cannot have a lower score than when you bought the house in the first place with. So you have to have a score that is exceedingly above what you purchased it at. So if your scores were low and you barely, by the skin of your teeth, made the opportunity to be able to purchase the house, you got to have at least a 680 to a 720 to really be in there good and being able to do the home equity line of credit, the second mortgage, or just to refinance the original mortgage loan itself. So, what we incurred this week with one of my clients is the fact that she was told by the bank that she needed to refinance. But if she was refinancing and already had paid into it almost 10 years, why would she start all the way over from the beginning? That doesn't make any sense because we are talking about, again, the interest that is accruing on that 250,000. So you would have already paid almost $100,000 down into the mortgage for paying it for 10 to 15 years, and then you want to start that whole process over again and pay the bank another 100,000. That doesn't make any sense. It would be better for her to just go out and see if she can accrue, saving the money, invest in the money, or to look at if she is going to do a home equity line of credit to only borrow what she absolutely needs, which means she could pull from her 401k. She could go and borrow less than the amount that she needed to repair her home, which was around $30,000. So as we were talking, she was already coming up with at least $5,000 that she could actually pull from her own pocket that she didn't even have to borrow. So I want us to really begin to think about when it comes to our mortgages, that we are looking at the entirety of the loan. We're not just focused on, okay, I can go get a home equity line of credit and all of this equity that's built into my home, I can pull all of that out and I can go travel, I can fix my house up, I can buy some new furniture, I can, go ahead and send a child to college or whatever you're trying to do. We don't want to think of it in that sense. What we want to do is think of it in the terms of how are we going to pay this back? Because just like I told my client this week, listen, I told her, I said, listen, think about this. What if an emergency pops up? You've refinanced the house at a higher interest rate than what it is right now. And now you are paying a higher monthly payment. Majority of the balance is back up to the full amount that you originally purchased the house for, and you're only paying interest. An emergency happens, and then you cannot pay off your mortgage. So as we get older, we got to think about, okay, what is 30 plus years by our age today? So if we are financing or if we're already in a mortgage, how much longer do we have to pay this mortgage off? And can we, based on our own structured budget that you can have at Kingdom Builders Credit Repair, how can we pay that off sooner than the time period that we are scheduled to pay it off for? So with a fixed mortgage, we cannot get caught up into the fact that it's just a fixed mortgage. We got to understand that even though a fixed mortgage is a great option, can we pay off the mortgage sooner than 30 years? Can we ask the lender to finance us if we are a first-time homeowner? Can we ask the lender to finance the house for 15 or 20 years, even though that will boost up our mortgage a little bit, but it will be worth it in the long run, because how many years do you actually have left to pay off your house? Okay, so that's just one type of mortgage. Let's talk about a couple of other types of mortgages before time runs out today. So I know I was getting a little happy and excited, but the second type of mortgage I want to talk about is the adjustable rate mortgage. Now, a lot of people back in the day when the housing economy crashed and everything with the stock market in the housing industry, we kind of like shun on adjustable rate mortgages. And a lot of people, and personally myself, we don't really engage into adjustable rate mortgages. But sometimes every blue moon, somebody will come across someone that's trying to tell them that an adjustable rate mortgage is the best option for you. Well, Michelle Green is here to protect you from what goes on behind the scenes of credit and finances. And I'm here to tell you that an adjustable rate mortgage may start out where your monthly payment and even your interest rate is very low. But what that means is adjustable rates is going to change after a certain amount of years. Let's think about it. So if it's an adjustable rate, that means that your interest rate can change and your monthly payment can change after a certain time period, usually around 3 to 5 years. And I've seen them as early as 1 to 2 years that the mortgage monthly payment will change and the interest rate will change. So let's say you bought a house for 250,000 and then your monthly payment was, let's say, 1,500 again. We're going to say that your adjustable rate mortgage, because you have an adjustable rate mortgage, they're going to tell you instead of paying 1,500 a month, you are actually going to be paying, let's say, $1,000. So you're thinking in your mind, well, yeah, I can do this because it's only $1,000. And I was already paying more for rent. So as a new homeowner or as a old homeowner, a 10-year homeowner, then you're thinking that, hey, well, this is a good deal. But in actuality, let's think about it. What if the next year or 2 years down the road, that $1,000 goes to, let's say, $2,000? Listen, I had a friend of mine that years ago, when the adjustable rate mortgages were very popular, she got in on the deal. Her payment started out at $700. It went up to like $1,200. Then it went up to like $1,700, and it just kept increasing until around the 5th year, she ended up having to lose her mortgage. She lost her house because she couldn't afford to pay for it. So a lot of times you got to think about the lenders are trying to put you in a position to where, yes, they are selling you the home and they want to give you this mortgage with this interest rate that starts out being low, but the interest rate and the mortgage payment will increase shortly after you have made the purchase. And what usually happens is an emergency comes up in your life. You might have death in the family. You might lose the job. You might change jobs. And maybe you're not making as much money as you previously were making. Well, guess what happens? You don't have the ability to continue to pay the mortgage. And as that mortgage payment increases and that interest rate increases, basically you're not paying anything towards the principal balance of your house. So therefore, it is very horrible for anyone to do an adjustable rate mortgage because you don't think about if you aren't in a better situation, if your credit score has not increased, you will not be able to refinance that adjustable rate mortgage and you will end up losing your house just like my friend did years ago. So stay away from the adjustable rate mortgages. There is in no way is a benefit for you. It is a benefit for the lender to say, I'm going to sell you this house today, and once you can't pay for it and the house is repossessed or foreclosed on, then basically I'm going to take that house from you and I'm going to sell it to the next person at the same mortgage loan. So at the same interest rate or higher and the same mortgage payment or higher. So that is a part of the mortgage gain. You got to understand what is the gain for you versus what is the gain for them. And there is in no way an adjustable rate mortgage is a benefit to you, the consumer. So make sure that you are aware of what kind of mortgage you're getting into. Now, the next mortgage I want to talk about is the FHA mortgage. Oh, okay, Michelle, you're talking about my arena. Okay, so many of us have a FHA mortgage loan. It is absolutely a great mortgage for the purposes of people with lower credit scores. It is good for a low down payment. But the problem with the FHA loan is that we don't understand that for a normal conventional loan, you would need to put down 10% of whatever the mortgage actually is. So what if we're talking about that $250,000 house? We're talking about 10% is $25,000. So if you ain't got 10% and you do a FHA loan, what actually happens is you are locked into the PMI insurance. What is the PMI insurance? Anybody that does not have enough of the 10% to put down as a down payment on their mortgage, they have to have this PMI insurance. The PMI insurance is going to say that you have to pay extra money towards your monthly payment. You have to pay extra money for this PMI insurance, that if anything were to happen, guess who gets the balance? Guess who gets the insurance benefit? The mortgage lender, not you, because it is protection for the mortgage lender to say that if you default on the loan, then the money is going to go to the mortgage company. And you're already paying for the insurance because you didn't come up with 10% down towards the house. So with FHA, it's great for people with lower credit scores. You could even get an FHA. Most of them start around 580 and up, but we want to get you to a point where you are in a position that your credit scores are much higher than a 580. You want to be around a 620, a 700. You want to be in a position where you can really have a much higher credit score than what they say minimum you can have. So let's make sure that we are not involving ourselves in FHAs if we cannot really come up with that 10%. And sometimes it's even 20% of the mortgage. So you're talking like $50,000 on a $200,000 house. So don't be caught up in the mix and thinking that, oh, these lenders are really for me. They're helping me out. They're looking out for me. Yes, people are good people. I'm not knocking that, and definitely not trying to get any bad feedback from the banks or lenders. Listen, I'm just saying that this is how the loans work, and we need to be made aware of what we are putting ourselves into and how we're going to pay the banks and the lenders back that we borrow from. And we need to know exactly what's going on while we're in the mix of having a mortgage. We don't want to be blindsided by something at the end of our mortgage or in between our mortgage or at the beginning of our mortgage to put us in a position where we cannot keep our homes. Okay, so let's talk about the VA loan. The VA loan is a zero down payment for any veteran, anyone that's been a part of any part of the military. That means that you will be guaranteed 100% financing. So what you want to understand is that the VA is a mortgage that you can get if you are military. You just need to, check with the military on the financing for a veteran loan. So you can get that at 100% financing guaranteed because the government is basically saying that they are going to back up the mortgage if you default. But the thing that you got to understand is it's still a mortgage just like everything else. So you got to make sure that there is awareness of the 100% is not just 100%, but also there are VA funding fees that will be included in the VA mortgage, even though you are getting financed at 100%. So there is a VA funding fee with the VA mortgages, and they are great because military US takes care of their people and other countries as well. So just want to make sure that you understand that even though you're getting a 100% financing, the way that you get the 100% financing is because the government is saying that they're going to back up the loan by 100%. If you choose to default, they're going to take over that loan for you. So just make sure that you understand that going into the VA loan, even though it's 100% financing, which means you ain't really got to put no money down, you ain't got to worry about the closing costs per se, but you also need to understand that going into that type of loan, there is a VA funding fee that you will not necessarily be exempt from unless there is a case of disability or some type of other disability related benefits that come down the line to say that you don't have to pay the VA funding fee. All right, so that's what the VA loan for a mortgage is about. Then we got the USDA loans, and I know my time is almost up, so I may have to do a part 2 of the home ownership, the secrets of the mortgages. But I want to say real quick, the USDA loan is another popular loan for mortgages that we tend to purchase. The USDA loan is also where we don't put a down payment. We have low interest rates, but it's usually only for people that are going to live or buy a house in a rural or suburban area. So it really does have a cap on location. You can't just get a USDA loan if you want to live in the city or if you want to live in some area that is not considered to be rural. If it's not a rural area, you will not be able to get the USDA loan. Now, also with the USDA loan, it does cap out at a certain amount of income. So if you are a first-time homeowner and you're trying to look at the USDA loan, you want to make sure that you fall within the income bracket of being able to get a mortgage with the USDA loans, because everybody can't get them. But the other thing that I want you to also be aware of, if there are any terms to say that this mortgage is locked in or restricted in any type of way, to go back to the people who help you to get the loan in the first place. Sometimes we have seen situations where someone purchased a house and it's a USDA loan and they couldn't get out of the house, meaning they couldn't sell the house until they had fulfilled a certain amount on the loan purchase. So please make sure that you are understanding the fine print before you purchase, and even in the event that you've already purchased, go back and look at the terms and conditions of your mortgage to make sure that if you decide to sell, if you decide that you want to walk away from this house, that there are no stipulations, no restrictions that will lock you in that home for a longer period of time than you want to be in it. So we got to make sure that we have full ownership. And that's what we mean when we talk about these mortgage secrets that the banks and the credit unions, the people that are lending out the money for the mortgages don't tell you, because at the end of the day, listen, it's a benefit for the bank and not for you. Okay, if you saved up enough money so that you can put the mortgage down, the down payment, the closing costs, or even part of your mortgage balance to pay it off, then you will have a much cheaper monthly payment, lower interest rates, and you would definitely have a better credit score, because that mortgage would not be weighing down your debts on the credit report compared to your income. Okay, so we want to relieve ourselves of being able to go into debt at any kind of mortgage. We want to relieve ourselves from just putting ourselves in a position to where we don't pay attention to what's happening in the actual terms of our debts, and especially our mortgages. And I'm going to say this because I know I'm already over, so I'm pretty sure that y'all are interested in me finishing this portion. So I'm just going to go ahead and finish, even though we're a few minutes over. If you have to leave, just go back and hit replay and do hashtag replay, and that's absolutely fine. But I just want to say this last mortgage is called the jumbo loan. Now, a jumbo loan is where you will pay a certain amount of interest. You will pay a monthly payment for so many years, usually around 20 or even 25 years. But maybe around the last payment, maybe you finance for 30 years, and around that last or next to the last payment, there is a jumbo mortgage loan inside of the loan that you have, which means that the monthly payment can jump from your regular monthly payment to a five-figure payment. You heard the words that are coming out of my mouth. Did you hear the words that are coming out of my mouth right now? Like, listen, I had someone also that I have dealt with, and several other people in the past, who had jumbo mortgages. When it came to the point where they were ready to pay off their mortgage, guess what? They couldn't pay it off because they had to come up with a five-figure amount of money. They had to come up with a five-figure amount, which means that they had a regular monthly payment that was like maybe $1,000. And then that last payment, or the next to the last payment, required for them to pay like $20,000 to $50,000 in one payment. And if that payment was not made, then the house would be foreclosed. So we got to think about, what are we involving ourselves in? That is like the worst of the worst. That's why I left this for the last type of mortgage to tell you about. The last type of mortgage is the jumbo loan mortgage. Definitely stay away from that. You don't want to involve yourself in any kind of situation where you are dealing with a jumbo mortgage. You don't want to involve yourself in any kind of situation where you got to come up, even if it was an extra like $10,000 to $15,000. Who wants to pay that as a monthly payment? Who wants to be prepared to pay off a 13 or 15 or $20,000 in one lump sum payment when you've been used to making your regular payments to pay off your house and you're almost at the end? See, that's a trick. And that's why it's so important for us to understand how mortgages work, how our loans work, how our debt works, how our credit works, and how to put ourselves in a better financial portfolio than where we are today. So let's get serious about our credit. If you learned something today, please put what you learned down below. If you're interested in getting into the Kingdom Builders Credit Repair Program, then go to our website, www.kingdombuilderscreditrepair.com, or you can go straight to YouTube. If you're already watching us from your YouTube channel, then listen, just click the link that's in the bio. The link in the bio will take you straight to the application for KBCR. You can fill out that application. Give us a call at 844-522-7552. We will be happy to speak with you about your particular situation, about your mortgage, about your process of being a first-time homeowner, and what kind of mortgage you need to obtain before it's all over, before they yank your collar and just do something that you don't want them to do. Okay, so let's make sure that we have all of our credit and our finance in alignment. Make sure that you are connected with us everywhere at kb.michellegreen. Make sure that you subscribe and tell a friend and let them know that you are learning how to manage your credit and finances right here on the KBCR TV show. Thank you so much for watching and for your patience to allow me to finish out the secrets to the mortgages today. And I hope that you have a blessed day and set those notifications for next Friday from 12:30 to 1, because you never know what we're going to talk about and how it's going to impact your life. All right, that's all I have for you guys. Take care and see you.
At Kingdom Builders Credit Repair, you are more than a customer. You are a partner in your credit repair journey. We offer one-on-one guidance in a warm and friendly atmosphere. Kingdom Builders Credit Repair, empowering people to have financial dominion on purpose. Visit us online at www.kingdombuilderscreditrepair.com. 1320 Main Street, Suite 300, Columbia, South Carolina, 29201. Call 844-KBCR LLC. 844-KBCR LLC.